Great. Yeah, thanks, Mark. So we have Brian Walter from Fairbridge Asset Management and Roman Beltrusco from MSQ. We'll see them on the presentation here on the panel. We'll be talking about private credit bridge loans, specifically around commercial real estate. I think first we're going to spend a few minutes. Brian is going to present kind of just an overview on the market. Again, this is for educational purposes only. This is not an offering to sell any assets. You can, Stonehaven has Firebridge is a capital raising client of Stonehaven through 361 and BG Partners, and also Fort Schuyler Capital has a cross marketing agreement. But at this, we're not offering or pitching. This is just for educational purposes. So get it out there. Brian, I think Mark has your presentation, so
actually
he can post it for you.
I'm wearing a lot of hats here. Brian,
Okay.
can you just can you present yourself? Is that possible?
Happy to.
Yeah, you should be able to share your screen, Brian.
Great.
There we go.
You see that?
Yes.
Perfect.
Yeah, I'll just give a short presentation. Thanks everybody for taking the time. What we're really trying to do is just educate and highlight what we think is the first inning of an enormous opportunity in private credit across the board, but in private real estate credit specifically. And I'll talk about why. And really, just to summarize it, I mean, the private credit has really been a long time in coming. It really started in the 1990s through bank consolidation, and a lot of small community banks that used to do a lot of real estate lending became larger banks as they've all been consolidated. Regulation after the GFC took that to another level, and we really saw the proliferation of private credit over the last 12 years across all aspects of private credit, really fill the gaps of the banks exiting lending in many, many arenas. And we think this regional banking crisis is going to take that to a whole nother level in private credit, and specifically real estate private credit, because the regional banks are such an outsized proportion of real estate lending versus the big SIFI banks. Regional banks are as much as they're about a third of all deposits in the country, and they're about 55% of total real estate lending and up to 70% of commercial real estate lending. So we think private lending is seeing an opportunity. I think all private lenders are seeing this reflected in their pipelines, which are growing rapidly. Just to put some numbers to this, bank consolidation, really we peaked out in the early 80s and are down now around 4,000. I think might even be below 4,000 now. And since the crisis, mortgage share of non-bank lending for mortgages has just skyrocketed to almost 70%. Really, the response, what caused this is all the regulation we discussed: Dodd-Frank reform, Volcker Rule, Basel III Accords, higher capital requirements, more paperwork, all the lawsuits that these banks paid, really caused the banks to pull back in many, many regards. In the lending life cycle, especially on the real estate side. Banks really don't want to lend against land, pre-development, acquisition, and construction for many, many customers. They do construction and rehab for their larger. That's becoming less and less given the recent turmoil in the banking industry. And stabilized cash flowing properties are really what they want to lend against. And that's where private lenders have filled the gap. They're willing to lend across the spectrum for a developer on the real estate side, and work with people. Timing is the other thing. Speed in which we can execute is the other thing that private lenders tend to accelerate on versus banks, which do all the paperwork and lawsuits that they paid or settlements they paid about lack of paperwork existing on these no-doc loans and things like that. It has really, really slowed down their process. And in real estate lending, timing is pretty crucial. So where are we today? About $1 trillion in deposits has left the banking system since rate hikes started. About 350 billion has left since SVB went under back in March. About 70% of that came from the smaller regional banks. About 2/3, why did this happen? About 2/3 of all bank households now access their banking system through online versus about 40% 10 years ago. So people are now accessing things online, and you can move money at the click of a button, as well as rumors about banks obviously spread a lot quicker in today's day and age. So as I said before, small banks, while making up 33% of the commercial deposits in the country, represent about 55% of all real estate lending. And that's where the opportunity lies as they exit and try and shrink their balance sheets. And the real issue is this slide where you have, uninsured deposits. And, we were no exception to this. Any bank, any business that has uninsured deposits at a bank with less than 250 billion in assets, small bank, this 40% chunk here in the middle, is feeling pressure from customers, CFOs, treasurers, whomever, to get that money into either a large bank or come up with some alternative, whether it's a nightly sweep into a money market account or whatever, to make sure that you're not leaving uninsured deposits in regional banks. And unless regulation comes, increase in insured deposit amounts comes through legislation, I don't see this leak stopping, where people continue to figure out ways to get uninsured deposits out of small banks. It's, being a fiduciary of other people's money, people have no other choice but to move it. And that is really we are in the first inning of people, moving money out of regional banks. And really what's going on is, banks basically have to get more liquid, right? SVB had about 22% of their balance sheet in cash and marketable securities, and it wasn't enough. So I'm sure regulation is coming that is going to mandate that banks be even more liquid, which means smaller loan balances. Their loan portfolios need to decline. That's why we're seeing tightening lending standards. That's the easiest way to reduce your loan portfolio, is to stop lending. And that is the opportunity that I think private credit is seeing across the board. So I'll pause there and turn it over to you, Paul, for the panel.
Paul, can I ask a question?
Sure.
Doesn't it seem counterintuitive that they should be in shorter duration? They should be in bridge loans in some ways, but they're just not set up to be for all the other reasons that you mentioned. You think of mismatch on duration, that was part of what was the issue, but they're still not able to fulfill that.
You're talking about commercial banks, Mark?
Right.
Yeah, I mean, look, they're short on two things. They're mismatched on duration. They're mismatched on liquidity.
Yeah, the shorter duration assets, the commercial loans, they don't have the liquidity. They're short duration, but they don't have the liquidity that
The fast liquidity.
that you need. I think it's like maybe you can get a loan sale done in 30 days versus a treasury you could sell a T+1 or something along those lines. So they definitely have the duration, but yeah, the liquidity is not going to be there. All right. Well, we got a set of questions here. I wanted to give Roman a second to give the view of an investor looking at the efficient frontier, or the spectrum of opportunities in fixed income or real estate in general, and how private lending and short-term bridge loans kind of make sense in terms of the other opportunities that he's looking at out there. Why how does this opportunity bridge loans in general kind of hit their needs versus some of the other kind of opportunities in real estate or fixed income in general?
Yeah, sure. Hi, everyone. I guess I can give you a bit of history about our family office and the way how we got into the credit space investments. So the background of our family office, MQ Capital, is primarily real estate, and investments on the credit side were new to us just 6 to 8 months ago. As investors, what attracted us were funds that issue senior secured loans while producing equity-like returns. We've come across various investment opportunities in the credit space, but decided to stick to real estate-related deals, as this is where our expertise lies. The financial mini crisis that happened in February, March this year, the current instability of regional banks, all of this obviously created a negative impact on the economy, but at the same time, this is also a big opportunity for private credit providers. The banks are now more worried about the quality of their book. They're more risk averse, which allows private lenders to charge higher risk premium and generate returns in the 15% IRR region with senior secured loans. To give another example, if I remember the figures correctly, the commercial real estate debt outstanding has been growing constantly since 2013. It's currently at the highest level ever. It is about $5.5 trillion, and around $2 trillion of CRE debt will be maturing within the next 3 years into a market with higher cap rates, higher financing costs, and many of these borrowers will be needing capital to fill in the gaps in their capital structure, which is again an opportunity for private credit providers to step in and benefit from market dislocation. In our investments and due diligence, we have always paid a great deal of attention to argue that right now it is a time to be a generalist, given the dislocation of the credit market and the opportunities it presents. But our family office so far decided to stick with our thesis of investing into funds that have specialized in a particular niche area and established their track record there of at least 5 years. Right now, we are actively looking for opportunities in the real estate debt, high yield and senior middle market loans, commercial real estate credit deals, hotel credit deals, and mortgage bonds markets. We're also monitoring opportunities in the fixed income space, mainly high yielding investment grade corporate bonds, and the bridge lending, the topic of our discussion today, also remains one of the key areas of interest for capital allocation. Currently, our investment mandate for the year focuses on cash flowing investments and those that can generate healthy cash and cash returns. And we were able to find these in the bridge lending space. I think that would be a bit of.
Great. Yeah, great, Rum. Yeah, let's maybe get into some fundamentals. Brian, I know your presentation, you had a slide on there, I think on maybe slide 15, that just kind of showed what the characteristics of a bridge loan is, just so, maybe kind of level set with everyone. Because I think that's important for people to see what terms we're really looking at, what kind of assets we're looking at, so people, everyone on the call can see what we're talking about. So, that's the question really. Like, what's the characteristics of a CRE bridge loan in the context of, this conversation?
Yeah. You want me to share that, or?
Yeah, share, please.
Typical, there are bridge lenders who focus on the office bridge lending world. There's people that focus on industrial, and there are bridge lenders that focus on residential. But we tend to like residential. But anyway, typical bridge loan, it's going to be 12 to 24 months, somewhere in the 40 to 70% loan to value range. These interest rates probably even low now. 9 to 13 is probably more like 11 to 15 today. We just closed the first lien loan at 15% the other day. Origination fees tend to be in the 1 to 3% upfront. Sometimes there's an exit fee, sometimes they're not. They're all interest only, with often an interest reserve of 6 to 12 months taken upfront at closing. These are loans to LLCs, developers. We have a first lien on the underlying collateral, the mortgage of the property. We also get personal guarantees. I think most bridge lenders get personal guarantees, especially in the sub $30 million loan size world, from their borrowers. And bridge lenders can close in 10 to 30 days, which is light years faster than most banks, which allows developers to take advantage of opportunities that may be gone by the time they could get bank financing.
Right, that's what I was going to say. The purpose of these loans, so it could be a construction project, but could also be where someone needs to do a fast close and a purchase, and then they plan to do long-term finance. Let's say it's a completed project. There's no construction going on, but it can't close in fast enough with a traditional 30-year term loan for the product or for the property. So they need to use maybe a loan like this where they can keep for a certain amount of time and then they can refi into it. So I mean the purposes vary, right? It's not just there's bridge. It can mean a lot of different things.
Yeah, there's plenty. It's bridge to something, bridge to sale, bridge to traditional financing, as the name implies. You certainly see situations where someone wants to buy something and they have other unencumbered assets. And so but it would take them 90 to 120 days to go get a mortgage on that asset from a bank, just through all the paperwork and time that it takes. By that time, the property they want to buy is probably gone. So they can secure a commitment letter within 10 days and go buy that asset, and the borrower or the lender will just take both pieces as collateral, the purchased building as well as the already existing building that the borrower owns, take both pieces as collateral to lower their loan to value.
Great. Okay. We've got some more questions coming in, and I have some more questions kind of to keep the panel going here. So one thing you had, Brian, is something on, I think we talked about the actual size of the market, and I think you had some kind of interesting estimates in terms of how you guys looked at it, like just how big the opportunity is or how big the need is based on everything you were mentioning of the banking market.
Yeah, I mean, I think Roman touched on, the size of real estate debt outstanding, but in terms of bridge lending specifically, there's not a lot of data on the private real estate market. Most of the data is in the private corporate credit market. But, there are some public vehicles out there that give you a pretty good understanding, especially in the sub $25 million loan size world that are, $1 billion, $4 billion, $5 billion. They don't operate nationally. They're only in 7 or 8 states. They only do one type of lending. They do construction lending, and they're $1 billion in size. So very, very large, especially if you lend to all facets, not just construction, and if you're a national. I think there's not a lot of institutional approaches to this sub 25 million loan size world where you do get, I think, better structure and incremental alpha on your interest rates because you're not competing against some of the larger players, like Fortress and Apollo who won't really look at any loan sizes below 50 million.
And maybe Roman, I want to talk about servicing a little bit. So you as an investor, you're going to be impacted by the performance of the assets, and you're going to look at the servicing of the assets. What does your firm look at when you kind of look at a counterparty and look at how the assets are going to be serviced, and what their either workout process could be or just kind of how they approach servicing? Because obviously it's different from a traditional performing asset, in the sense that there's possibly more for the servicer to do, and sometimes the servicing is done by the originator. So maybe hear your thoughts about what you look at when you talk about the servicing, and then we can talk about maybe some more about performance too.
Yeah, sure. I guess it's kind of hard to just provide a general answer to your question, because each loan is kind of unique in itself. What we've been kind of paying great attention to when diligence into these deals was related to whether the investment manager had the experience of managing the foreclosure before. whether they are not afraid of taking control of the asset and managing it themselves, whether they have the capability to do so, whether they have a vertically integrated system to allow for that. In a way, we've been kind of tackling this risk from investing into funds that target lower LTV ranges. So ideally, we were looking at LTV of 50 to 55%. That was our target range. So I believe like these were the key metrics of how we were evaluating the ability of the fund manager to underwrite loan servicing and manage defaults. We've been during our first steps, we've been kind of a bit hesitant to enter deals that had default rates of 5 to 10%, because I believe we didn't quite understand that this does not directly translate into a financial loss. In a way, with a good fund manager, a default situation presents an opportunity to generate outsized returns rather than incur a financial loss. So this is kind of evaluating the fund from the perspective of their ability to manage the asset when things go wrong was one of the key points in our due diligence always.
Yep, I think that's an important point, that defaults and losses are obviously two different things. And with the lower LTV, defaults don't necessarily translate into a loss. And then even because of the low LTV, but also because there's also default interest rates, and so the assets actually accrete at a higher rate if the loan goes into default. So that's kind of something to keep in mind as well. And Brian, one thing on the construction loans, there's typically some draw process. I don't know how you guys look at it, but maybe in general on a process where it's a bridge loan that has construction, typically the borrower doesn't get all the funds day one. They get some initial amount of funding based on the appraisal, but then as they make improvements to the property, they can get the ongoing release of funds in line. And is that how you get? Sometimes like it's all up front. Sometimes people release over time. How does your firm look at that?
Yeah, I think the best way to structure a construction loan is obviously, the whole philosophy is you don't want to lend beyond what value is being created at the site. So you don't want to lend against future value. You want to lend against current value. Obviously, during a construction loan and a construction process, that is constantly in flux as the project is being completed. So they request construction draws. People that are watching this carefully, we have a construction consultant that goes out to the site and make sure if they're wrecking for windows, to make sure they're there and being installed. And then we will give them credit for that on the construction budget and reimburse them for it through a draw. And that process has, a bunch of documentation and, but ideally on a construction loan, you want the borrower to put out their equity first. Generally, let's say 75% LTC, loan to cost loan. So they put their 25% in first. A lot of the risk in the construction is taken out because the biggest risk portion of construction is getting out of the ground. That's where most of the problems happen, if there's going to be any. And hopefully their 25% accomplishes that, and then your money comes in after. And as you can imagine, if you're lending, if it's a $10 million project and they spend 2.5, your first $1 million, your LTC is very low. You're one of 3.5 million, and then your next million is your 2 of 4.5 million. So you actually never get to 75% of cost until you put in your last dollar of your 7.5 million of the 10 million. So, and at that point, the project is almost complete, and the value portion has been created. So your loan to value has shrunk well beyond 75%.
And Andrew, I see your hands up. Do you have a question?
Yeah, Brian, going back to just conceptually, you have the chart where you started what banks don't do. Banks, no land, no prep, maybe good customers for construction. That whole process. separate where the banks and you sort of stop crossing over, in the sense that somebody's putting up the equity, this is what you said, somebody's putting up the equity, and I'm just using this for reference, it's not literal. You said personal guarantees. I mean, I guess seen that here and there. The point being is that you've got pretty secure loans, the way I'm hearing you underwrite them. And it doesn't sound horribly different than what a bank would ask for, where I think his name was Bo, said they were willing to do lower LTV loans, obviously for higher rates of return. So where are you and where are the banks, and how come there's no overlap? I'm missing something maybe?
Yeah, I mean, there's a little bit of overlap with regional banks for sure. They do real estate lending, but they tend to want to lend against cash flow, right? Their analysis, they want on cash flow because A, they're not equipped to take over projects, as Roman alluded to earlier. B, nor do they want to, right? They just want to get rid of non-performing loans and keep their balance sheet as clean as possible. But so they're not really doing, I mean, yes, they're getting appraisals and things like that and looking to lend against the value of a property, but they really want to lend against the value of a cash flowing property, which has occupants, which is a less risky endeavor, right?
Sorry, but isn't that where you get past the bridge loan, construction loan, and into a mortgage? I mean, once you've got, cash flow, you're into a mortgage, right?
You are. I mean, there's, they'll do some light rehab. I mean, there's really, the lending world is really broken into two pieces. There's the debt service coverage ratio world, which is a fancy way of saying how much the cash flow of a building covers the interest expense of that building. Mm-hmm. And that's driven by Fannie and Freddie lending. And there's a whole world of pre-Fannie and Freddie lending that happens amongst Greystone and Arbor and Corvus and some of these Fannie and Freddie lenders. But they're all based on debt service coverage ratio. But then there's a world where a building doesn't have any cash flow. So then that whole world does not want to lend to that project. And that is largely, banks do not want to lend in that world. They will for their larger customers because they want the deposits on the other side, right? So if you're a builder that doesn't have $5 million sitting in the bank account, you're probably not getting a construction loan from your regional bank, right? There's definitely a quid pro quo. So that is where the banks are willing to step down, in those situations to those borrowers that are helping their business in other aspects. And, the whole point of my presentation is that they're now stepping away from even wanting to do that because they need to shrink their loan portfolio. So many borrowers calling us mid-construction with banks wanting to leave the bank because it's becoming very, very difficult. And this has been going on for 6 months, not just starting in March. It's just accelerated. It's just very difficult to get a draw out of a bank. It takes a week to schedule them to come out. Then they've got to do their report. Then they have to get 3 sign-offs before the money's released. That's a 3 to 4 week process. We get our money to our borrowers in 7 days. So if you think about the working capital stress that puts on a developer who's got 15 projects going on at once, when he has subs that need to be paid, it's worth them paying incremental interest to not deal with that.
Okay.
And we talked about how the recent events have, created the opportunity why people need bridge loans. I guess one thing, and Roman, happy to hear what your view is. How does recent events affected the performance of bridge loans? I think one area is probably in valuation. Whether upfront or the ongoing or post project, but do you have any thoughts on how recent events have affected credit performance or expecting to affect performance over time?
Yeah, sure. I guess Brian will be better equipped to answer this question from the perspective of the fund manager, but to us as investors. What this created, obviously, some of our real estate investments suffered because of that, because of what it entailed. But at the same time, this opened up another kind of new area to us that we saw in the credit space. And so far, thanks to kind of good management of our real estate investment, we were able to mitigate losses on that side, and we were able to benefit from the new opportunities created on the credit side, because as regional banks suffered, the competition for loans in certain areas within credit lowered significantly, which, as I was saying, provided kind of an opportunity for private credit providers. This is all kind of very general, like each area within the credit had its own kind of unique characteristics. But for us, I believe this window of opportunity is still there. From what we have been hearing and what we have been projecting internally, I believe this kind of environment of credit market dislocation will last for about 18 to 24 months. This is kind of the general consensus that we've got. And yeah, the time right now is definitely beneficial to step into the credit side of investments, I believe.
Great, Brian. Do you have any thoughts in terms of performance, or what credit performance is going to be affected by recent events? You're on mute. Sorry.
I think interest rates, certainly, I think the thing to keep, at least on the residential side where we focus, is valuation. So, interest rates obviously are moving around cap rates, which is one component of valuation. The reason why we like residential is because there's a lot of data, there's a lot of transactions. So valuations and getting current valuations is something that I think is a lot easier than in office and retail. So that's why we like that part. Obviously, underpinning it all is a housing shortage in this country. So not only do we focus on residential, we focus on workforce housing residential, which there is a real need for. Away from that, rental rates have obviously had quite a run here over the last 2 years. So that's, helping on the cash flow side. And then, just looking at some of the questions in the chat. I mean, on the downside, when you do have to take back a property and you're at a 50 or 60% loan to value, you have plenty of cushion. Look, we try with our words. We're not trying to take back property. We're not loan to own sort of borrowers. We just want to be paid back. So as long as they're in communication with us, we'll work with them. It's going to cost them, given they're needing more time or whatever. We're not, we do charge 24% in default interest rates in our documents. Doesn't mean every single time we get that or even ask for it. Sometimes we'll settle at 18 or 17 just to move on and get the project to where it needs to be so that we get out of the loan. But I think many bridge lenders who do this product well, we put ourselves as one of them, have never experienced principal losses. When you're disciplined on loan to values and have the proper documentation, you can manage that, even in a default environment.
Yeah, Duncan had put a question into the chat here, and I'll read it. It says, if the banks are going away, who is going to take out the bridge loans? Meaning, I guess at the refi or when you're going to the full maturity financing on after the bridge loans matured. What is the potential source of funding for that kind of for the project at that point?
For which part?
When let's say the bridge loan's maturing, what takes and the project's complete, what takes out the property at that point? Like, let's say.
Yeah. So banks aren't the only takeout here. Saw that in chat as well. Who's going to take these out? Banks aren't generally. That is what Fannie and Freddie are for, right? That is what that's why the government has those agencies. That is the ultimate end game for cash flowing properties that are investment properties. is, to go end up in Fannie and Freddie programs, which require 85 to 90% occupancy for at least 3 months to access those lending programs.
That's like a Freddie Mac K loan, something like that.
Yeah, something like that. It's one of the products for sure. And then all the lenders that have those licenses that are approved Fannie and Freddie lenders have their own products that are basically a bridge to Fannie and Freddie. That feeds their pipeline of Fannie and Freddie loans. But that's the ultimate takeout, right? At the end of this whole chain of financings, it's get a cash flowing prop that's stabilized and is occupied and is eligible for a Fannie or Freddie Mac loan.
To be like a market rent, roll, and it has to be a market interest rate kind of, like those two things are going to be, I guess following up in terms of, one goes up, they both go up, in this market right now. Rents are going, you see rents going up in certain markets, but interest rates are going up, in all markets. And that's going to be something that's consistent. All right. We don't have anything else kind of prepared. If anyone has any other questions, we can open it up for questions. You can just raise your hand, or we can give it over to Mark. Oh, Duncan has a question. Go ahead, Duncan.
I was just going to follow up on that question because it seems like, we have this regional bank issue. And we probably all try to get a mortgage on their house and see how long that takes or something. So the business of these bridge loans and the quick execution makes all the sense in the world. I suppose those companies almost treat that as part of their CapEx or something, the developers, right? But I'm trying to understand, a year ago, what was the takeout? And going forward, what is the takeout? And have the parameters of the takeout tightened up such that you need sort of a less levered, more cash flowing? What's changed in a year on that? I personally don't think the regional banks are going to go away. I think we have some movement going on the margin, but they do perform a social good, and not every real estate project wants to borrow money at 12%, right? I mean, the world works because you borrow that money at some cost over funding, but not an excessive cost over funding. And I'd be surprised if that really goes away. So the commercial banks or the regional banks played a role in that. Fannie and Freddie played a role in that. But it feels to me like your business model is tied to the takeout because you're lending for 12 to 24 months. And I just wonder if I'm sorry for being so long-winded, but I wonder if you could just explore that part of the exit a little bit in more detail.
Yeah, happy to. First and foremost, our product has existed well before this regional banking crisis. Product's been around for decades. There's many needs for it. I mean, in full disclosure, the first time I came across it, I questioned why this product exists as well. Speed and convenience is just one of the things people pay for, but there are certainly many instances where banks just don't want to lend to either the borrower or against the collateral. Point though on what's changed with interest rates is, just giving you round numbers. In general, someone could get a finished product that was not yet occupied and get probably a 75 to 80% loan to value, as is value, against that finished product, and recycle their equity, right? So we did a loan to someone that was a $10 million loan. They put up $3 million of equity, so it was a $13 million project. The value of that property when it was done was $24 million. And then they would go to an Arbor or a Greystone, and they would get a $19 million loan, an 80% loan against that 24 million value. And they would give them a year to ramp up the occupancy. He would take that 19 million, pay off our construction loan of 10, and he's already tripled his equity. That $19 million loan is now, given higher interest rates because it needs to meet certain debt service coverage ratios, probably 13 million. And so the macro picture is you used to get 80% of a finished product, and now you're getting 65. So there's this 15% funding gap, right? So all these builders were using this 80% sort of takeout to recycle their equity into new projects. And now they're only getting 65. So they have all this equity trapped in their finished products that they used to be able to get out. And the market that's trying to step in and solve that problem for them is the mezzanine and preferred market. And that is why the mezzanine and preferred market is salivating, because they never were able to get 16, 17% yields and only be 75%, 77% deep in the loan to value cap of the capital structure. They used to have to go to 85, 90. So they're stepping in, trying to solve this 10 or 15% funding gap for these developers. So that's what's changed. So what do we do today? We certainly price that takeout loan. In my example, we're sitting here pricing that 24 million after repair value. We also have a relationship with Greystone who will even do it independently for us because they want us to refer that business to them. And making sure that whatever that takeout loan is based on today's interest rates is big enough to take out our loan. If it's not, we won't do the loan. We'll make them, to your point, we'll make the borrower bring more equity to the project to make sure the takeout loan at 6.25 rates is big enough to take out our loan.
Okay. Seeing there's no more questions, Mark, I think we can thank our panelists and hand it off to you.
Sure. No questions? No more?
Actually, Mark,
Yep.
one more, just some clarification. Brian was talking about workforce housing. That's that's a niche. The list had kind of a little bit of everything on it. So I've seen people that, really specialize like that, or people that just do construction, or people that just bridge to improvements, you name it. So how thematic are you versus willing to do anything in residential?
Yeah, I mean, we're very sponsor focused. So it's the biggest thing with what we do. There's always some sort of value add component to the use of our dollars. There's some value being created, and so you need to make sure you're lending to someone that can execute on that value creation, and that is one of the biggest focuses that we have. And we've spent a lot of time cultivating borrowers. So we have about 45% of our portfolio is repeat borrowers, people we've lent to before. We know how they act. Look, problems happen. That's just part of this business.
Sure.
And we just want to make sure we're the first or second call when those problems happen. And we want to be in the trenches with people. We know how they act when problems happen. It's the borrowers that go dark on you, and then you have to go through foreclosure processes and things like that, that create issues. Most problems can be solved with a little bit of time and a little bit of flexibility. So as long as they're communicating, we can work through them.
Okay.
I guess and that sort of goes to point of concentration or otherwise diversification in this loan market. Diversification among sponsors, diversification geographically. Maybe you can speak to those risks and how you address them.
Yeah, I mean, obviously portfolio construction, which, this goal goes into, if you're excited by this space and you like the opportunity set, you got to make sure now you're picking a good horse to exercise it with, and you want to pick people that bring an institutional approach. I mean, as I said, particularly I run a family office. That's where I came across this product, and I looked at about 20 bridge lenders when I did a deep dive on this product, and not everybody brings an institutional approach to this product. So you want to look at players that, do things like get audited. Audits, have multiple years of audited financials, have third-party administrators, have credit committee, have credit memos, all the kind of good things that I think most people on this call are used to due diligencing when they're speaking to managers, because there's, portfolio construction is a big part of that. Making sure someone doesn't have a loan that represents 20% of their portfolio. An obligor doesn't represent, 30% of their portfolio. I certainly saw that 6 years ago when I was due diligencing this product in many instances. And then lastly, fee structures or, I certainly came across many egregious misaligned fee structures.
Anyone else? On the subject of private credit or bridge lending? So let's just call it a pause on this one. Thank you, Brian. Thank
All right.
you, Ramon. Thank you, Paul. Thanks everybody leaning in with questions, and
Thanks for the time.
Thank you.
Thank you, guys.
Okay,
see you next week, if not before.
all good.
Bye-bye.